Hi everyone, Donnie Schultz, Embrace Home Loans here with markets on Monday, actually Tuesday, May 31st. Hope everybody enjoyed the holiday weekend. We took a week off last week. Apologies, I was home fighting COVID, but we're back. 2 weeks ago, we talked about a potential ceiling forming on interest rates. That has played out over the last 2 weeks. We've seen rates pull back by about 0.375%. So great opportunity over the last 2 weeks, 2.5 weeks for borrowers going into contract to capitalize on lower interest rates. Towards the end of last week, though, we were locking buyers in. And the reason that we were locking buyers in is because rates had pushed down to the bottom end of what I'm anticipating to become the channel that rates are going to be trading in and moving in over the next few months. I would say probably 3 to 6 months. I think we're going to be in this consolidation phase where rates are bouncing between 5%, 5.25, 5.375, probably in a quarter to 0.375 range. I do think that signs are that rates have topped out, but I think we're going to be at these higher interest rates, these elevated interest rates, for the foreseeable future until some economic data comes out pointing towards lower inflation, which really means economic slowdown. We're starting to see that. We're starting to see that in reports. We're starting to see consumer confidence go down. We're starting to see manufacturing numbers go down. We're starting to see some pressure on stock markets. And the last couple of inflation reports have not pointed towards higher inflation. They haven't pointed to lower inflation, but they haven't pointed to this continued kind of runaway inflation fear that markets are concerned about. So it will take time. We're going to need to see more data come out. For now, we're playing the range. I think we want to be super defensive with rate locks. I don't think there's going to be much that's able to drive rates lower than what we saw at the end of last week. 10-year Treasury was testing a pivot point around 2.72. It tested it for 3 days in a row. It couldn't break lower. Again, we took a lot of locks off the table, and that turned out to be a really good decision today as the 10-year has bounced higher, and we're probably going to see about 1/8 of an increase in rates on today's sheets compared to last Friday's. I think there's probably more pressure to go upwards. I think the 10-year will most likely retest 3%. As long as there's no data or global events coming out that would push it above 3%, at that point we would expect the ceiling and the consolidation to hit and for 10-year to start coming back lower and rates to start coming back lower. So in this environment, buyers need to be defensive. There's going to be certain points where we would probably be advising against locking, and that would probably be as the 10-year gets a little closer to 3%. We would be looking for that ceiling there. That might be not the greatest time to be locking in a rate. Today, though, we're locking. Even though rates are 1/8 higher than they were on Friday, this 10-year is most likely going to continue to move higher here. It's going to go up to 3%. That's going to be another 1/8, possibly even 1/4% on rate sheets. And buyers don't want to be in a position where they're chasing interest rates at that point, because if that 10-year is sitting at 3% and all of a sudden an inflation report comes out that shows elevated inflation or increasing inflation, or maybe there's news out of Russia, Ukraine, it could potentially trigger another leg up in interest rates here. So you have to be super defensive. We're keeping a close eye on everything. But markets are really going to be data dependent. We're going to be analyzing every economic report that is released, and those economic reports are absolutely going to have an impact on interest rates. So buyers need to be working with lenders who are aware of this, who know that, hey, Wednesday we have payroll report coming out. We have manufacturing data coming out. Those are tied to the economy. It's tied to inflation data. Friday, probably the bigger day with non-farm payrolls. That's always a big report. These reports come out before interest rates are released. So if a lender or a buyer is not aware of the risk going into, say, Friday, they could definitely be putting themselves in a bad position if they're floating out their interest rate. If anybody has any questions on rates, programs, you can reach out to me and my team anytime. Hope everybody has a great week. Talk to you soon.